Thursday the 20th of April, the briefing underway, and overall I would say assessment of the overnight news has been relatively little. There's not been any outright big news developments from overnight. If anything, markets still seemingly a little bit of digestion of the bigger price movements, certainly in the FX markets that we had earlier in the week with the announcement, surprisingly, of that snap election for the UK. But some interesting things have happened last night, and just having a quick look at the S&P. And one of the things that we've had is some selling pressure, really initial move higher as we broke the prior day's high technically at the open of Wall Street trade yesterday, only then for it to see quite an aggressive about turn. Oil, which we'll talk about shortly, saw a pretty sizable move to the downside. It wasn't kind of a snap reaction on the inventory data, but certainly after that had passed, prices certainly came under some pressure and some technical levels were broken. That certainly weighed on the respective names, and this equity market continued to move lower. And the thing that interestingly was missing was a late aggressive rebound in price action that we've been so accustomed to seeing in the US equity market. Typically what has been happening is when we've had a fairly big move to the downside, it gets countered quite aggressively by heavy buying into the last hour of trade or so to recover what would be fairly marginal losses in the end. Albeit though, when you actually look at the percentage changes, although that looks fairly large on the futures chart, in the cash market the S&P was down about 0.2%, the Nasdaq was actually up, and the Dow was down just over 0.5%. So these aren't exactly cataclysmic losses in these equity markets. It's just the fact that pattern-wise we didn't get as big a recovery late in the session. However, going into this morning, you are starting to see a little bit of movement. And just looking at the DAX, just one quick word on that. We put the DAX down on a minute chart here. This is just more for the newer guys, looking at the fact that you had the gap up overall in Asia, a fairly moderate tone. The ASX, the Aussie market, was a little bit higher, financials helping negate some of the weakness from the commodity sector after that fall in oil. The Nikkei was benefited by some trade data, exports were up, some decent moves in some bellwether names like Toshiba. And the Shanghai comp was also higher. Reports of tax cuts and the PBOC, the central bank, upping its liquidity injections, just helping lift the sentiment slightly. So you gapped up a little bit here in the futures market in the DAX. Then we've kind of done very little, which is often the case, until 8 o'clock when the cash market opens and you get that immediate spike of volatility and as volume comes into the market. Now, one of the things is when you're assessing the overnight news, really there was not a great deal of negatives there. As we've just assessed, Asia, if anything, had a positive spin after a slightly mixed close on Wall Street. So we had that initial blast lower, and if you look slightly longer dated, we broke then that Eurex close low in the DAX. The 1200 handle obviously went, which was in the futures market holding before the cash open, and then yesterday's low also was taken out. So you can see probably here just an aggressive run lower, only to be countered quite quickly, and a whip saw price action back up to the upside. Now, I'm not saying that this could be telegraphed and you could have just bought the low down around that S1. What I'm saying is that just be very mindful of that opening price action around the cash open in the futures market if you're trading the DAX. It can be highly erratic in price movement. The one thing here, looking at it from a news perspective, is that on balance, really there's not a lot negatives to justify the initial spike to have continued lower. That's the one thing maybe you could have taken out of that move. But with the way that the market moves in that particular instrument, which is highly volatile, then it would have been quite a difficult catch at best. So again, just to be mindful of around the opens in European equity markets. The other thing that we're seeing this morning, the dollar a little bit weaker once again. And actually, I just want to quickly show you a couple of comments that we had last night to get you up to speed with some of the headlines. You probably recognize this chap by now. This is Stanley Fischer. He's important because he's the vice chairman of the Federal Reserve, so he's basically Janet Yellen's right-hand man. And the headline kind of says it all. US monetary policy normalization likely to be gradual. So we've gone, it seems, back full circle to this slow and gradual communication from the Fed in order to not spook the markets, that there's going to be any impending fast rate normalization cycle. If anything, inflation has been tailing off, and that's also been reflected in the market's pricing as well, in terms of inflation expectations going forward on the delay from Trump's fiscal implementations. You also had some comments out of Rosengren, albeit Rosengren is a non-voting member, said that the Fed's balance sheet reduction could begin relatively soon, and that the tightening of short-term interest rates should not need to be much different than it would be in the absence of shrinking the balance sheet. So a little bit more on the balance on the hawkish side, but again, a non-voter, with Fischer taking the more kind of weighted impact, if you like, given his hierarchy on the Fed structure. So the dollar's a little bit softer, not pinning it all on this comment, but it's to be aware of. Dixie down 0.2%. So if you're looking at both major pairs this morning, we are on the front foot. A couple of additional polls just still cementing Macron with the bigger advantage going into the French elections on Sunday. So, you know, you've not had a breakdown or a last-minute game changer there. Maybe that's just keeping people still fairly confident that he will qualify for that second-round runoff against Le Pen, which, as we know, and we'll look at shortly, still would mean that he's got a high probability of winning that presidential seat. Cable, likewise, we were looking at that big level yesterday. Given the snap higher that we had on Tuesday evening, that was when we blasted through that really key level of 128.06 that just got marked here on the green from that previous support level post the EU referendum. We obviously broke that on the back of the day of the announcement of the election. Eventually triggered a huge amount of shorts getting squeezed from an institutional level, so much bigger volume and size, hence the very sharp reaction in the market. And then last night we got very close just after the European close, after we left the market. We kind of gravitated towards that 128 level before then just making a slight move to the upside again. I guess downside, definitely this 128, I guess defining the low from that from late US session, 127.89, up to the kind of range that's formed now since then. We'd just be watching on the kind of intraday basis. I guess when you're taking that into account, we're kind of midpoint at the moment. On that note, let's have a quick chat about the political situation in the UK, because this did one of the main UK headlines in the FT this morning is talking about Labour draws up the most left-wing manifesto since Michael Foot years. So we're looking back to 1983. That would be the most left-wing since the party sank to a defeat under Michael Foot with that very left-wing manifesto. Now, you know, fair play to Corbyn for sticking to his political view, if you like, and that he isn't changing his stance. He's kind of sticking to his guns, trying to appease, I guess, the northern powerhouse, where his influences felt the most strongest. However, to me, this is only going to, it's just a repeat cycle, if you like, of why Labour has lost popularity in this new economic and political environment, where people are a lot more akin to moving, if anything, further to the right rather than way to the left. And so all this is going to equate to, for me, is just it's going to influence probably more people to think about either joining the Conservatives or the Lib Dems as a credible alternative for their vote to have any type of influence, especially when you've got conversations going on about as well, the SNP are in play, and they're a fairly powerful force with over 50 seats in Parliament. But there were some talks as well about Labour. The only way they could really technically gather enough seats to cause the Conservatives some issues was if they were to team up in a more progressive alliance with the SNP. Likelihood of that happening, though, is probably very low, although Sturgeon has said that she would be open to those talks, Corbyn to a lesser extent. He seems to think that Labour can manage it on their own, which is, by most estimates, a bit of a far stretch, most would say. But looking at an interesting poll that we had, there was a YouGov Times sponsored poll which came out last night, which encapsulates a little bit of the sentiment which is important to monitor post the announcement of the election. And the Tories are on 48%. This is in comparison to the week prior, so it takes into the week change now that we've had this latest piece of news. So this is the first YouGov poll taken since Theresa May called the election, and the Tories are now at their highest popularity since May of 2008. So the Tories are now almost at their most popular in a decade at this present point. So them winning a majority really is a bit of a non-starter. It's how much of a challenge do they get from other political parties if there is any type of alliance, or if the Lib Dems make any headway, which then in combination with the seats already captured, which Scotland are unlikely to change given their pro-EU stance, that's the kind of areas that we need to be watching. As you can see here though, the Lib Dems actually, there's been no change at all, which is quite surprising, I find. I would have thought that would have seen some change. You can see though that the likes of UKIP, which is understandable, I'd say, given the fact that they've gone through a bit of a leadership crisis, they seem to have fallen away. Farage was really it was all based upon him and people's almost liking and backing of him as an individual that really led that party surge in popularity about a year ago when we had the initial e-referendum. So UKIP have fallen quite substantially, other parties are down. This has all gone into actually mainly the Conservatives. Labour actually at +1. Now we did do an Amplify poll, granted much smaller, but what's quite interesting to see is actually it's a fairly similar makeup to that big nationwide poll that came out of the Times. Conservatives running away with an outright majority, but you guys actually looking at, there's 118 votes there, so fair few. You're actually looking at Lib Dems have picked up a little bit. They've gone from around the current kind of 9% to 14%. Labour pretty much sitting where it is, but majority moving into the Conservatives. So if anything, on the balance, the two charts kind of reflecting the same story. People are liking what they're hearing from Theresa May. I was reading about her communication strategy, about these words of her reinforcing, I think it was 2 words, something about stable. It's basically based on repeating certain phrases to get into the psyche of the public about stable and authoritative and consistent against what would be otherwise a manic political coalition mess, to try and make people continue to back her and how they see her as being a respectable, or the most respectable and credible candidate to take on this task of an EU negotiation process. One of the other things though to be aware of, I know we've just talked about UKIP, but I thought I'd have to comment on this guy. There's only 2 people in this world that wear socks like that. That's Nige and Will DeLucy. Will DeLucy actually has a pair of those socks. So if I see those 2 on the train chatting to each other, you need to watch this space. But Nige seems to never go away. It seems as soon as the cameras come out and the media takes some interest in politics again in the UK, out he comes. And he seems to have jumped back from the pond after being the dinner partner of Donald Trump, and now he's back to suggesting that he hasn't ruled out standing again in the June 8th general election. Now, as much as that sounds quite farcical and we all have a laugh about Farage, it could be quite interesting. Not that he would have any great sway, but it is him that captures a lot of media attention, given his views, given his personality. And UKIP, as we just saw in the sentiment polls, have been declining quite substantially. That's not to say then that he could pick up quite quickly that party's hopes if he was to get involved. So maybe just something to contemplate. Moving over to the bigger thing for the here and now, because actually the time is running out for this quite important trading event. Just so you're aware, on Trading Live, they're going to be the coverage on the Squawk channel is going to start at 7 p.m. on Sunday. I think the exit polls come out at around 8 p.m. London time. I'll have all of these finalised and we'll do a full briefing on Friday. But the Squawkers, they're going to be covering this all the way from early evening on Sunday. So ahead of the open, get you up to speed, and then you can trade it accordingly. Remember, this first round is really important because depending on who goes through, the market will probably already jump to conclusions then what that means for the final result. Now, polls wise, hasn't really changed. We continue to monitor them day by day, but what was seen as really a three-horse race, Macron, Le Pen and Fillon, is now got a fourth dimension with Mélenchon, and so you definitely need to be aware of the risk that the far left candidate, more radical view that he would carry if he were to qualify and not Macron on a runoff against Le Pen. That's kind of the most market impactful, I would say, in the short-term knee-jerk reaction if that were to materialize, given their negative views on Europe. The most baseline scenario, Macron and Le Pen, certainly would be the most kind of European asset friendly in the short term. I'm talking Sunday night, Monday morning when we come back in and European equities get underway, moderate relief rallies might be seen. The bigger move obviously is to the downside. Relief rallies are much smaller, particularly in an event which carries quite a large tail risk if scenarios like Mélenchon were to get through. Again, we'll talk about this more on Friday. Other things to be aware of, I just wanted to have a quick look at oil again because we did take a phenomenally big move to the downside, surprisingly actually, because we had, so let me just highlight where the oil inventory data came out. Now, oil inventory data was pretty messy, I would say, and the point I was making to the guys yesterday that it's largely an untradeable event when it is like the release we saw yesterday. It certainly doesn't deviate enough from the market priced in expectation enough to create a defined moment to be able to enter that trade. You had initial spikes down, then up in very large candles before then we saw this prevailing move to the downside. Now that move certainly was quite interesting. I guess if you look slightly longer dated, you broke the previous kind of consolidation that we had had between the kind of 52.5 and 53.5 type price levels over the following 2 days, or the previous 2 days. And looking slightly longer dated, it puts us back down to, towards 50, which is obviously a key psychological barrier. But just looking at some of the price movement, it puts us down back to levels that we were trading at, really reversing much of the gain seen earlier this month. So in the grand scheme of things, we have rallied a hell of a long way in crude oil over the last month as a whole. So maybe just opening up a little bit of profit taking on some of that overall move. But there are some things to be aware of here when assessing the news. So obviously there's a few technical levels that gave way, likely helping some of this move. Also momentum moves as well. You can see here a break on S2 yesterday, comes back up to retest the level before having another move to the downside. This all happening in quite aggressive selling all the way into the traditional, what would have been the NYMEX pit close, before then market participants kind of stepping out of the marketplace. Now, looking at the numbers, the headline crude was nothing really too much to shout about. The one, I'd say there was two elements of the data that gave it a slightly bearish spin, that being a slightly larger build in the gasoline number, which overall, if that product specifically futures starts to move lower, it can weigh on the general complex of energy products as a whole. Then also US output was up once again, about 0.2% when rounded up. So that's a continuation of a theme that is ongoing. Now the important thing here is what tends to happen when oil comes under a day of very heavy selling pressure. You know, you guys tell me, what's the news that you can predict that you would probably be seeing today after a day when oil has seen a dramatic collapse in price? Now we fell about, from the oil inventory data yesterday to the low, about 4.5%. Yeah, jawboning, OPEC cuts, OPEC to the rescue, plunge protection team. You're exactly right. All these different things. We've seen this time and time again. You know, if we go back to a daily continuation chart, you know, let me just tidy this up 1 second, and we can have a look at, they did this before already, right? We've been here before. Now this is looking at only the last, well, if you look at this is 2017, I marked up here. So looking at this side of the chart, it was really when US output, so this side of the chart here, US output was here. People were getting very fearful about the incline at a fairly rapid pace that shale production was coming back online. Operational rig counts have been on a consistent trend higher by a fairly rapid rate. Then there's a very key area here where we had very aggressive verbal intervention in this period by OPEC, crying blue murder, we need more production cuts, we need to do more beyond the 6-month agreement that expires in June of this year. It's all about now jawboning in order to verbally intervene to force the price back higher on the premise that they're going to do more. Again, this is only words, nothing more than that. Now that you've had a slight breakdown here, what's interesting is that the price point seems to have come around 50, whereas before we got down to 47. It almost feels like OPEC's getting a little bit desperate. Before they seem to be happy to let prices go a little bit further, they seem to be getting less and less patient in stepping into the market. Now this has very negative long-term implications. You know, the old child story about the boy who cried wolf certainly does carry some weight in terms of how the market responds to persistent rhetoric without any actual action. So what we've had this morning, and exactly as you guys were saying, is you've had Kuwaiti oil minister says OPEC, or says expects extension of OPEC non-OPEC deal. That was in Reuters last night. This morning, the Saudi energy minister, there is an initial agreement on the need to extend oil output cuts, but more talks are needed. Obviously, this being the most influential person within OPEC. Russian energy minister Novak says OPEC non-OPEC output cut deal successful so far, could be extended another 6 months, according to the Nikkei report. Although latest comments, potential extension deal is still under discussion, reiterates too early to comment on OPEC deal extension. So a little bit mixed on the Russian side, but the point being from all of these comments is that they've already started to step into the marketplace to negate the fall. And this is interesting given the fact that they've decided to do this quite quickly around the $50 handle, not wanting prices to go any lower from here like they did back at the end of March. So, you know, watch this space whenever oil sees a big down day, and certainly if we get sub 50, I'd be expecting the OPEC rhetoric to ramp up, and the big deal, or power brokers if you like, are getting a deal done are of course the likes of Saudi, Russia, and then also Iran to some extent. Whether or not they get further exemptions and so forth, given their history with Saudi in coming to a compromise, is always a difficult one. You know, there's headline noise may well return to crude oil, which can throw up some opportunities to trade for the more kind of activist profile. Okay. Okay, one thing though, just to finish with the oil situation, a headline story I did send out to you guys this morning and may explain some of the initial weight or why the market's been a little heavy overall. And this is just some analysis looking at the fact that developed nation inventories are higher now than before OPEC cuts. So actually this whole oversupplied nature of the market is still actually quite a prevalent theme. And if you're looking at running to a standstill, so once OPEC cuts expire, oil inventories won't be much lower than where they began. So despite the action that they've taken, if they were to just call it a day with the agreement that expires in about 2 months' time, actually the overall dent to what is an oversupplied market is actually minimal. And so therefore they haven't actually achieved too much, which most analysts then would suggest that they are pretty certain that they're going to go on and actually do more cuts going forward. That seems to be the kind of consensus on Wall Street at this point. Don't forget they've got meetings, I think, at the end of May. Well, they've got the OPEC official meeting at the end of May, but they've said they want to have meetings prior to that. As you always know with OPEC, the actual Vienna scheduled meetings are always quite well telegraphed. Normally a bit of a non-event because the market's already factored in the decision making given how vocal they are about what they intend to do and what action that they will take. Okay, quickly then, quick look at the calendar, and fairly quiet overall. So you've had the Japanese trade data overnight, you've had the German PPIs this morning. To get you up to speed with that, it basically printed the same as the prior month. It was actually a touch lower than expected. Expected was 3.2, it came out at 3.1%, but it does put producer inflation in Germany at its highest level since December 2011. Still driven by an increase in cost of energy. So, you know, it'd be interesting to see if oil prices and energy prices start to decline, this being factored in, whether or not, having already seen Eurozone inflation for the March final figures yesterday start to tail off slightly. So this overall inflation theme, which was actually dominating a lot of market movement about 6 weeks ago, seems to have just dissipated slightly. Certainly if you look at the likes of the pound as well, quite an interesting view I was reading from one opinion piece this morning was talking about negating the price pressures of import prices for the UK if the pound does start to see a concerted break to the upside. Does that start to moderate this inflation fear in the UK? Slightly more longer run, I guess, in that view. Otherwise, in the afternoon, you've got the regular Thursday release of the weekly jobless claims. You've got Philly Fed. Again, I'm not really looking for these to rock my world in terms of price movement, but speaker-wise, you do have Fed's Powell, who is a voter and is speaking in the economy, so that does need to be monitored. Mark Carney is speaking. I've had a look on the Bank of England website. I can't actually see what the exact topic is, but I'll keep you posted on that. And then you've got Rosengren after the close. So a fairly quiet day. This, of course, as well, is leading into potentially what is a very, or does carry a very large risk associated with it, and that is the French election on Sunday. So if you think about it and you look at, you take a step back from, trading the markets intraday and short-term movement. If you were a bigger institutional player in the market or a fund looking to throw around some bigger size, would you really be stepping into the market on Thursday ahead of that event on Sunday? What I'm suggesting then, potentially we are in for a fairly quiet Thursday and Friday. Calendar is very quiet, and a lot of people might well just be sat in terms of bigger money on the sidelines. Now, why would you risk putting capital to play ahead of such uncertainties? Now, we've already seen Trump and the EU referendum go the way of the outsider, if you like, and I think a lot of people will want to see this first round play out before having a bit greater confidence then and more conviction of where they think this market is going in the medium term. Okay guys, just gone 9 o'clock, So I'm going to let you get on with the session. Thanks for listening, and I'll see you in the chat room. Thank you.